Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. Investors are currently faced with a lot of uncertainty from geopolitical concerns, inflation rising again, uncertainty around monetary policy, and a host of others. Well, I'm very excited about our next guest who can provide us with a better understanding of the current macro backdrop, as well as an investment strategy that you may want to consider when building investment portfolios for this uncertainty. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am honored and very excited to welcome Jerry Pryor. Jerry is the Chief Operating Officer, Senior Portfolio Manager, and Managing Partner at Mount Lucas Management. Jerry, thank you so much for coming on the show. I'm really excited about this conversation. Can you please tell us a little bit more about yourself and Mount Lucas Management?
Sure. And first of all, thanks for having me on. I'm happy to be part of this conversation with you today. So hopefully we can talk about some things, to learn some things, and get going.
I know I'm going to learn
I'm
some
not sure
stuff.
how
So.
enlightening I can get on the current macroeconomic world. I think everybody's sort of struggling with that, but maybe some of the things we talk about today will resonate and, hopefully give people some tools to address this environment. So a little bit about us at Mount Lucas. We've been in the managed futures business for 4 decades. We were founded in 1986. We came out of a firm called Commodities Corp, which was based in Princeton, New Jersey. It was one of the sort of founding places for managed futures investing and global macro investing. A lot of big names came out of there, like Bruce Kovner, Paul Tudor Jones, guys like that. So there's sort of a rich history behind where we came out of as a firm. Commodities Corp, like I said, was in Princeton, New Jersey. It was on the corner of Mount Lucas Road, where we got our name. The other cross street was Poor Farm Road, which we passed on for as commodities trading advisor. Poor Farm Road was not did not seem the way to go.
Right,
So
right.
so you know we started in the managed futures business. The reason we spun out of Commodities Corp was because Eastman Kodak's pension plan to come to Commodities Corp to run a managed futures portfolio to get some portfolio diversification.
Okay.
In their stock bond portfolio, they were looking to add in sort of a liquid alternatives bucket and to give them some protection in different types of environments. And Kodak's pension fund was a risk of money. You needed to be registered with the SEC as an RIA. Commodities Corp didn't want to do that at the time. So we spun out of there for Mount Lucas with the sort of the sole purpose of bringing managed futures investments to the institutional marketplace. So that's the short history of where we come from. We've been doing it ever since. In 1988, we created a managed futures benchmark called the MLM Index. That is a sort of a passive way to access the managed futures market in sort of a more cost-efficient way relative to the traditional fee structure of 2 and 10, which you see a lot in our space, or have seen a lot over the years. So
Very interesting. Well, I give it to you. You guys really did a good job choosing the right name.
yeah,
Um,
yeah.
a smart move. A
It's a
smart move.
little before my time, but
Yeah.
I've been with
The
the firm.
founders.
Yeah.
Awesome. At Zephyr, very similar. There's a cove on Lake Tahoe called Zephyr Cove.
Hmm.
And the founder, 4 decades ago, lived on the shore in Zephyr Cove, and that's where the name came from. So it's always
Yeah,
interesting where firms get the names.
absolutely. Yeah, there is actually no Mount Lucas as far as I know. As far as I know, it's just a road, not
Yeah,
an actual mountain.
got it. We talked about the macro backdrop very briefly, and it is It's very dynamic right now. A lot of uncertainties. Can you try and maybe make sense of it all? We've got equities have sold off, yields have fallen, the backdrop that we talked earlier. What's going on? Can you help us maybe give us a little insight there?
Sure. Well, I think really what well, I I can opine on this plenty, but I I think what's really driving things, and I think what people are really struggling with, the market is really struggling with, is uncertainty. We have an administration that has come in that has large goals, treats
Mhm.
volatility as a feature, not a bug. They, in some sense, are looking to reshape how the economy works in the United States, and uh, to the degree that balancing budgets, which creates sort of austerity effects that we're
Mhm.
seeing going in place now. Tariffs, which is meant to bring back more manufacturing and more sort of middle class jobs back into the United States. Those are really large goals, and they're trying to be. And I mean, I think Trump came out over the weekend and said, we're going to rip the Band-Aid off here, and we're going to go through some pain in order to reshape the economy, or the American economy, in sort of in his in his the way he sees it, or the way he thinks it should be run. I think up to this point, markets have priced in the Trump, well, prior to the last few weeks, sort of post-election, the markets were, pricing in all the sort of positive aspects of the Trump administration, right? He's going to be positive for stocks. He's going to lower taxes. It's going to be good for businesses and companies. And what we're seeing now is the realization of what he's really trying to do with tariffs, and sort of the austerity effects, the deficit reduction through either firing government employees, or uh, cutting 2 trillion out of the budget. However, they're going to get there. All those things are going to lower aggregate demand. The market's trying to figure it all out all at once, and then there's plus the uncertainty of there are going to be tariffs. Now they're not. Now we're going to cut some stuff out. Now it all of which really makes it hard for businesses to plan, for investment managers to plan, put plans in place, and have some sense of what they should be doing in this environment.
Jerry, that's fantastic. And I think you said it right at the beginning, uncertainty, right?
Yeah,
Markets, we know one thing is for certain, markets don't like uncertainty. And what we have right now is uncertainty. So, um, perfect explanation there. So we've got all this uncertainty. If I'm a financial advisor trying to create an investment portfolio or something, what's an investment strategy? That often can be overlooked by some, or is often overlooked, that might help with this current uncertainty.
yeah. So I'm going to sort sort of speak for the home team here, and and preach managed futures a little bit. Again, managed futures as an asset class has been around a long time, and there's been times where it's been in favor, and there's times where people have been frustrated with it. But ultimately, I think what managed futures gives portfolios is some optionality toward uncertainty, right? It what drives returns in managed futures are dislocations in price, big moves in bonds, big moves in commodities or currencies, and the sort of the ability that what trend following gives you is the ability to be on both sides of the distribution. Where if you're in your typical portfolio of stocks and bonds, you're long only.
Yeah.
Stocks go down and bonds go down, you're in trouble. Like 2022 is a good example of that. Most people have bonds in their portfolio to sort of protect against their stocks. They count on that sort of traditional negative stock bond correlation, and
Right.
bonds are going to be there to protect. And for 30 years, that was true, and you didn't. We weren't worried about inflation, and that sort of Fed put always existed until it did in 22. And sort of with inflation, you know, it, you know, in front of you. It's come down a lot, but it's still the price levels are still high. People are still worried about it. The Fed's still worried about it. So the amount that rates could come down in order to protect stocks, that relationship is uncertain at this point. And I think what investment managers need and RIAs need is more tools in their toolbox at this point, and where can they get diversification, and protection and risk mitigation, and in sort of an efficient way in an asset class that's been around a long time. And I think managed futures is that. It's done really well in stress environments, like in 2008. It was we were long bonds and short commodities, and that was and long the dollar, and that was fantastic. But in
Hmm.
2000, and that was a deflationary period. Where in an inflationary period like 22, we did really well that year, being short bonds and long commodities. So completely opposite sides of the completely opposite positions.
Hmm.
But we were able to do well in either of those types of environments where stocks and bonds may have been struggling.
Fantastic. And you said it too, Jerry. Managed futures, you tend to do well when bonds, move a lot. And right now, there's a lot of yield volatility out there, right? So when you're
Yeah, and
looking
it's
at,
been I'd say over the last 18 months, it's been sort of difficult for the way we do things. You know, the primary way to access managed futures returns, and I'll probably talk about this in a little bit, but um, is through trend following, right? So if prices are going up, we're long, and if prices are going down, we get short. It's not particularly complicated. Um, but what's happened over the last 18 months, we've gone through a couple. Well, we've had volatility in bonds, which we didn't have for
yeah.
all the teens. Uh, it's been sort of going in a sine wave, right? It's been, you get an inflation print that ran a little hot at the beginning of 24. It's rates are going to stay higher for longer. Bond prices come down. Then we get that stuff over the summer where you had the yen trade and the carry unwind. Uh, all of a sudden we move to I think we got a cut all the way to the point the Fed's got a cut, and in September, and then we start pricing aggressive cuts out for the next year. Bond prices are running up, and then they turn around and say, well, maybe we went too far, and cycle back down, and sort of through the beginning of this year, and then now we're headed back up a little bit. So that sort of cycle for trend followers is not great.
Mhm.
But eventually, I think that some of these positions are going to settle, and sort of make a move, a directional move,
Okay.
that'll benefit managed futures and investors for sure.
Fantastic. So let's talk real quickly before one of my favorite subjects is talking about portfolio management, creating optimized portfolios. But what type of and you mentioned it too, what type of investment or macro environments do managed futures perform better in, or maybe not perform as well in? As you
Yeah,
said, following trends, and when trends are easy to decipher, it's probably harder. But
yeah. So I think let's talk a little bit about why what managed futures is, why it even exists in the first place, and because there is good reason. So futures markets have existed in the United States for over 175 years. So those in an exchange traded form. So these markets have been around, as long or longer than stocks
Mhm.
in the U.S. It's so there are it's a real thing, and what futures markets exist for an entirely different purpose than stocks and sort of credit markets, right? Stocks and credit markets exist so business and companies who want to build and grow their companies, they go to investors for capital. You give them capital, the investor seeks to earn a risk premium, uh, by participating in the future growth of that company, whether it's capital appreciation, future dividends, dividend growth, all those sort of well understood things that every investment advisor understands and is putting their client money to work in. Futures markets exist for a different reason. They exist to transfer risk. So or transfer price risk. So it's those same businesses and companies that face sort of exogenous price risks in the running of their business and the operation of their business, whether it's interest rate risk or FX risk
Mhm.
or commodity input or output risk. Those businesses, if those prices, if interest rates move, or if FX markets move, or if commodity markets move that are inputs or outputs from their business significantly in price, it can materially affect their bottom line and affect their margins. So they need to find a place where they can go and say, hey, I'm a corn farmer. I'm planting corn in the spring. I can, I can grow my corn, plant it, grow it, market it, harvest it, sell it, or up through
Mhm.
harvest for about $3 a bushel. The current price in the spring is $4 a bushel. I have about $1 profit margin. I can sell forward my crop. I can lock in that dollar profit margin,
Okay.
or I could not do that and take the risk that by the time I harvest the corn, corn is $5 a bushel, and I can and my margin's better, or it could be $2 a bushel, and I've just lost my farm.
Yeah.
So what the farmer's doing is he's going into the futures market and locking in that price. So and that exists on both sides too. So for every
Mhm.
corn farmer, there is a General Mills is making us some
Mhm.
cornflakes, or I don't know if it's
Yeah.
Kellogg's or General Mills, but um, and their buyers are corn, and they can't make their cereal without corn, and the price of corn uh, is a determinant of how much margin they make on that box of cereal. So where we sit as investors in the managed future space is where those businesses and companies are looking for price certainty and going to the futures markets to get it. What we do as investors is own price uncertainty. So we're giving them price certainty, and we're owning all the uncertainty. And so what those businesses and companies are worried about are big price moves, right? They're worried about prices going way up or way down. They're not worried about stable prices. Where we do well as managed futures is when prices move way up or way down. That's when we do well. That's our investment risk premium. So owning all that price uncertainty, that's our risk premium. Uh, and so when markets are moving, that's when we do well. When markets are stable, you look at a zero interest rate environment in the teens where bonds didn't move, not a great environment for us. You look at '08 or 22 or right in the middle of COVID, those are great environments for us because prices are really moving. We follow the prices, and um, we're able to participate on either the long or the short side. So
Mhm.
like I said, the way we own that uncertainty, and so this is the mechanics of managed futures. um, you know how the best way, the most used way, what people have been doing for 40 years in managed futures is trend following. That is
Mhm.
a systematic way of accepting price risk through time. So we trend follow across lots of different markets,
Yeah.
bonds, currencies, commodities. Uh, in our case, in our index, the one we built, it's 22 markets in all. So five global bonds, six developed currencies, 11 of sort of the biggest commodity futures markets, all in futures.
Mhm.
And we simply trend follow the price in each of those markets. And all that is earning the managed futures risk premium by systematically accepting price risk through time.
That was fantastic, Jerry. I'm gonna cut that up and I'm gonna share that
Sure.
part. That was such a great way of putting managed futures from, the beginning to now. And I love how, it's the transfer of price risk.
Yeah.
Um,
Yeah. That's
and
exactly. In Finance 101 tells you can't transfer risk for free. You
yeah,
know.
right, exactly. Um, so it's interesting too. You talked about, you benefit when prices are moving versus being stable. So I can see why, you know, in times when there's some uncertainty and there's prices moving like kind of now, you know, that's where adding managed futures to an investment portfolio, there's some benefits there.
Yeah. So managed futures. So ultimately, this risk premium that we're trying to earn is
Mhm.
ultimately it produces a return distribution that is sort of wholly uncorrelated to stocks, right? So over the long run, I'd expect the correlation to be zero.
Mhm.
What tends to happen is we get pretty negatively correlated in periods of stress, right?
Mhm.
Because if you think about what drives our risk premium, it's also what hurts equity risk premium. That uncertainty and volatility. If you like in the Ukraine war, you had a big run up in commodity prices. That was painful for stocks. But being in 2008, we had oil going from 150 to 40 or 30. So in COVID, we saw oil go from 100 to minus 20 or minus
Yeah,
30. So
something crazy.
those are pretty. So those sort of big stress events that really drive our returns are really, uh, that kind of uncertainty in the markets, uncertainty in prices is really difficult for equity markets, and that's where we sort of get our negative correlation during periods of stress. So ultimately, where we sit in the portfolio, and I think as people are putting together their asset allocation, and you get stocks and bonds, and what else am I trying to add? Or am I trying to add? Um, if people go into the private markets, am I just adding more equities with an illiquidity premium?
Mhm.
Or is that my step into alternatives? Or if I'm going in alternatives, should I be prioritizing diversification? In which case, you want uncorrelated assets. Managed futures is great because it's liquid. Particularly, the underlying futures markets are incredibly liquid. We deliver multiple structures for clients, but ETF being one of them. Very, very, very liquid. The ETF's liquid. The underlying instruments are liquid. They're all market priced, all level one price. Level one futures exchange traded price. You know exactly what it's worth every single day, and the market's extraordinarily deep. So what that means is if we are really providing uncorrelated returns and diversifying results, because of that liquidity, you're able to monetize that diversification through rebalancing through
Okay.
time. So
Mhm.
if you got an asset allocation to stocks and bonds, we always tell clients, you want to own managed futures as sort of a core holding, and rebalance it regularly, quarterly, semi-annually, annually, or even monthly. That might be a little much for some people, but even quarterly rebalancing in '08 and 22, or during the COVID pandemic, um, you're really able to monetize those returns, those sort of
Mhm.
stress market returns in managed futures, and then pour them back into equities and be a buyer of equities during the downturns, as opposed to a seller. And I think that ultimately that's the long-term sort of asset allocation story around managed futures.
Yeah, I'm glad you brought that up because, at Zephyr, we really focus on helping financial advisors create optimized investment portfolios, the efficient frontier, and, to withstand different market environments, to try and increase that Sharpe ratio, reduce the downside risk. And I'm really glad you brought that up with managed futures within the investment portfolio. What was interesting is you mentioned a core holding. Um, so I'm assuming with managed futures, like you said earlier, sometimes it works, sometimes it doesn't. You might get frustrated with it, but I feel like the key when it's within a portfolio is you got to have patience.
Yeah, and you gotta, those periods of stress, as much as we'd like to think we'll see them coming, we rarely do, and we rarely are able to put our money behind that thinking in a sort of time efficient manner. So it's one of those things you just need to have there. Uh, and I think, and you said, something about sort of the frustration of owning it. I think one of the things about managed futures is its greatest benefit, is its greatest weakness, is that what trend following does, the way you think about it, you have sort of, if as the market's going up, you have unlimited upside with a trailing stop. Whether a moving average, depending on how you're doing the trend following, but you typically, to keep things simple, you got the price and the moving average, and if the price is moving up, the moving average is trailing behind it. We have unlimited upside and sort of a cap downside. Well, because the moving average is your
Mhm.
stop. What ultimately, when you're doing that over time, systematically through time across many markets, you end up with sort of a positively skewed distribution, right? You always sort of cut your left tail, but you have an unlimited, or big fat right tail, uh, and you get a positive skewed distribution. So what that looks like is, one way to think about it is, in equities being a negatively skewed distribution, right? You get the big tails on the downside, but you get pretty steady returns on the upside.
Yeah.
You get In equities, you get more observations above the mean. Feels good every day to own equities. You get to pat yourself on the back and say, hey, I'm a really good investor. And then twice a decade, you know, uh, you got to cancel the tea times and talk to your clients. Uh, with with managed futures, totally opposite experience. You know, your average return is, or you have more observations below the mean, uh, and a couple of times a decade, you thank the Lord that I've got that as a core holding in my portfolio. So that's what makes it sort of difficult to own. It's uncomfortable. It's a different return distribution. It's different benefits. Computers love us. Asset allocation models love us because of that positively skewed distribution
Mhm.
matches that negatively skewed distribution of stocks. Uh, but for humans, looking at 1 3 5 7s, uh, it doesn't always look good in a 1 3 5 7. So
Yeah.
you really have to understand the story. You have to understand why you own it, um,
Yeah.
and really look like how it looks like through time in an asset allocation model or a portfolio
Yeah.
optimizer.
That's a great example. And again, like at Zephyr, we really look at the analytics, like skewness, kurtosis, and really dig deep into the analysis of a return distribution. So I'm glad you brought that up. It's not just annualized return and volatility risk, right? When you're looking at managed futures. And you've said it numerous times. That 60/40 portfolio was broken and during times of crisis, and it doesn't have to take, a black swan event. The correlations between stocks and bonds increase. And when you need it most, when you need diversification most, it's not there. It's broken for you. Like you said, 2022 is a perfect example. You need that piece of your puzzle, piece of that portfolio that.
Yeah, as long as inflation is a concern. I mean, you know, today's the day. Stocks are down, bonds are up, and good. But as long as inflation's out there, inflation's a concern. You're just never going to be able to count on it like you did in the teens. Sort of post GFC.
You mentioned they're liquid and one of the biggest topics right now is alternatives. So where do you put in, managed futures? Is it more of your typical alternatives or, liquid alternatives when you're building that portfolio?
Yeah. So I would, you would definitely put it in the liquid alternative spot. I think the world's been, you know, really focused here over probably the last 5 or 10 years of really heading into privates and finding ways to get into privates. There's even, I mean, I think they just launched a private credit ETF out there,
Mhm.
which I read through that a little. I'm still struggling to uh, be on board with that structure, but you know, so I think so. What alternatives is a weird asset class, right?
Yeah.
It's not really defined. It's like it's other, right? A lot of people use it as the other asset class,
Yeah.
and it sometimes gets defined by structure, right? If I'm in LPs and privates and things like that, that's what I call an alternative. But you can have things in another structure, in a hedge fund structure that look just like equities or just
Mhm.
look just like bonds. Private credits, bonds, you know, but not public.
Yeah.
Private equities, equity, but not public equity. So, where we sit, liquid alternative
Yeah.
space, I think as an asset class, um, we're more on the diversification end, so we don't look any. We're an uncorrelated, asset class. Again, I think the rebalancing argument is really strong when you think about alternatives. So when I think about alternatives, for me, if I'm going into the alternatives world, I want something that I can use to diversify my portfolio, and again, this is home bias. I prefer liquid investments because rebalancing is one of the only free lunches in finance, and you can't rebalance things in LP structures in private structures, or you can't do it efficiently as you can with liquid alternatives. So, for me, I want something that's diversifying, something that gives me some risk mitigation, and something that allows me to monetize that diversification and put it back into my asset allocation through rebalancing. Because ultimately that's what uncorrelated assets are meant to do. They're meant to generate returns, uh, but it's not about letting those returns run. It's about monetizing them and pouring them back into your portfolio.
Yeah, exactly. And I've had so many conversations over the past couple of years about alternatives, and it is a big bucket. There
Yeah,
are
yeah,
so many different things within alternatives. When I started 20 some years ago, it was REITs, right? Just
right.
REITs is kind of your alternative sleeve for retail investors, and now it is just ballooned on the different types of alternatives.
Yeah. Even on the liquid side, you got long short equity, but
Yeah,
really that's just low beta equity. You get, you risk parity guys out
yeah,
there. Again, I have no problem with people risk balancing portfolios. But again, that only gives you the long side of the distribution. Your long
yeah,
stocks, long bonds, long commodities.
yeah.
Uh, you know, Managed futures allows you to have sort of access to both ends of those return distributions to be long or short bonds. In 2022, uh, there was no other asset in an inflationary world. Like in 2022 was an amazing year because you had most people in the investment world had never seen a world of inflation,
Right.
and the things that everybody thought would protect them during inflation, like gold, tips,
Mm.
which ended up being bonds more than it was
Yeah.
more the treasury part was everybody realized the treasury part of that was way more important than the inflation part of the tips. Gold. I mean, even Bitcoin. Maybe somebody thought that was going to protect them. uh, you know, those they were all a disaster. And really, if managed futures by being short bonds and long commodities uh, was sort of the best performing asset class during that period. And gold here definitely certainly had a really good run, sort of
Hmm.
driven by uncertainty and
Yeah.
sort of geopolitical risks and things like people trying to de-dollarize, but uh, managed futures picks that up too. So
Very interesting. Yeah, 2022, that's going to go in the academic books on. There's going to be a lot of case studies and research done on 2022 and what happened.
yeah, I mean, you had to think almost like inflation had been beaten and was out of
Yeah.
academia.
Yeah.
It sort of we didn't need to teach people about it. We didn't need young people are joining the investment world. You just didn't need to teach them. Don't
Well,
worry about inflation. If stocks go down, bonds will go up. It's fine.
yeah, exactly. I remember, it was 5 years ago now, maybe, but pre-COVID, there's a lot of articles. Is inflation dead? Are we ever
Yeah,
going to have to, all these articles and headlines, are we ever going to
yeah.
have to worry about inflation?
Why?
Yes, we
Why?
are.
Yeah. Why should we worry about deficits when bonds are zero?
Yeah, exactly. Exactly. Real quick, they got one more minute here. What are some misconceptions of managed futures? If maybe one misconception out there that you hear most often.
I think I mentioned it before. I think the main thing is understanding how to live with a positively skewed distribution, and 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 understanding. You go through sort of long periods of stable prices, and equity markets are going up every year. I think that's it's hard to hold on to the thing at when you put that list, you look at the end of the year and you list the rates of return again on that 135, and managed futures has been at the bottom the last 2 or 3 years because equity markets are up 20 or 30 every year, it starts to get hard to hold. And
Mm.
you really got to understand, um, why it's in your portfolio, when are good periods for it, when are bad periods for it. Because it's, even though it's systematic, even though it's quantitative, it's not a magic money making machine. It's not meant to make money in all environments all the time. There's a risk premium there. We earn it when things get stressed, or
Mhm.
either at the macro level via inflation and deflation, or at the market level where there's supplier demand imbalance in a particular market, for whatever reason. So I think really it's about just sort of understanding. I think understand holding uncorrelated assets is hard. It's a hard thing for a human being to do. Easy for a computer, right?
Yeah.
Hard for a human being because we all make associations and inferences in our heads. It's what we do. It's what we do as humans. We you know, uh, you know, we sort of form those things. Like, I get up in the morning, I look at what are stocks doing, and I'm like, well, if stocks are up,
Yeah.
bonds are going to be doing this. Everybody likes those little cheat codes in life of, if this, then that, and everybody understands a one correlation. If this happens, then that will happen. Everyone understands a negative one correlation. If this happens, the opposite will happen over here. But uncorrelated, zero correlations, if this like I come in, I've been doing this almost 30 years as well. And I come in every day and I look at like everybody else, I look at the S&P and I go, well, if stocks are up, then I don't know what managed futures is doing that day. And I think that's hard for people. I think that's hard for people to understand. And, they put in their portfolio to be a risk mitigator, but at the first day it doesn't do well. When stocks go down, they go, "What's wrong?" Well, it's uncorrelated. As things get stressed and prices start to move, yeah, we'll get there. We'll get on the right side of things.
Yeah.
We definitely need the stress periods to last, several months to 6 months, a year, to really have that, big impact. But yeah, I think as humans, we struggle with zero correlation and understand and how to live with that.
Jerry, fantastic. Thank you so much for coming on the show. As expected, you dropped a ton of great knowledge. Very fun conversation about managed futures. A needed conversation. I loved it. Thank you. Thank you so much, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel. And also, please give us a follow and subscribe to that Zephyr YouTube channel. Thank you and have a great rest of your week.
Thanks for having me on, Ryan. It's been great.